Telecom is one of two major telecommunication providers in the Philippines. It has segments in mobile, broadband, and fixed line. Globe also has a 40% stake in Mint, which operates the e-payment platform GCash. In 2019, internet services accounted for 75% of Globe's total service revenues, mostly from its wireless segment. We initiate coverage on Globe Telecom with a buy recommendation. At the closing price, Globe has a market cap of 267 billion pesos and a free float of 21.9%. So why buy Globe? We have four main arguments which build up our recommendation as follows.
For our first argument, we believe that the market has overstated the effects of mobile competition. First, the mobile industry is capped at 3 players because of the limited availability of spectrum rights. These rights are assigned so that telco operators won't be confused as to which frequency their network is using. But with substantially all of the spectrum already assigned to current players, this prevents any fourth player from entering the mobile industry. Next, although stronger competition might cause a price war, this is unlikely because the mobile market has ample room for growth. We highlight that there will be growth in both the number of data users and data consumption. Thus, operators could grow without the need to take much market share from other operators. Even with the entry of a third player, Dito, we think that Globe still has a huge advantage. Primarily, Globe has a large head start in terms of scale. On top of that, the common tower policy would only be a minor help because towers in place will remain exclusive property of those who built them. And lastly, we think that Globe can match PLDT's expansion due to their similar financials. In addition, Globe has historically been better at identifying consumer trends than PLDT. Historically, Globe registered a 7.4% yearly mobile revenue growth compared to Tel's 3.8 yearly revenue decline. Having said all of that, despite the stronger mobile competition, we think that Globe's mobile segment could still grow at a 4.14% CAGR.
Globe can scale more effectively through its superior home broadband strategy. From 2019 to 2025, home broadband penetration in the Philippines is expected to increase by 15.3%. Globe's unique strategy will allow it to capture a significant portion of that growth. The strategy is to focus on fixed wireless products, which are cheaper to deploy and avail, and to use consumption trends to determine where to set up postpaid connections afterwards. This strategy is effective because first, fixed wireless broadband relies on the same network as Globe's 4G mobile SIM cards, which already covers the entire country. Second, industry demographics show that lower income households have lower broadband penetration. Due to increasing demand, Globe's affordable and prepaid fixed wireless products would make it easy to gain more subscribers. As a result of this strategy, Globe grew its home broadband subscribers by 1.5 million year on year in 2020, which is 1.27 times of PLDT and Converge combined. Other players will have a hard time copying Globe because they have different strategies or lack the needed assets. Thus, we believe that Globe will benefit the most from home broadband trends and could deliver 10.3% CAGR from 2019 to 2025.
On to our third point, we highlight Globe's ability to deliver shareholder value through dividends. We believe Globe's dividend payout is characterized by both safety and upside. By year 5, we think Globe's yield on cost could reach 8.8% due to higher EPS and payout ratio. We think the safety of Globe's dividends lies on the fact that telco services are a necessity. This gives Globe a steady subscriber base and will provide stable EBITDA margins even during economic downturns. Complementing Globe's stable margins are its strong cash flow and balance sheet. Over the forecast period, Globe is expected to have a 41% CFO to revenues ratio. Meanwhile, Globe's debt ratios are below its covenants. For investors, this means Globe can fund capex using cash flow and debt without resorting to dividend cuts. We also think that Globe's dividends possess upside. Given that Globe is projected to have a 5.7% top-line CAGR, we see Globe delivering a robust 5.8% EPS CAGR. This will increase the base from which dividends can be paid out. Even though capex will be high in the short run, we forecast decreasing capex by 2025 because we expect the number of cell towers to be near the government's 70,000 goal. Consequently, this will allow Globe to increase its payout ratio over the long run. To conclude, we think Globe's dividend possess low downside and compelling upside.
On to our fourth point. Apart from Globe's core business, It has significant exposure in the high-growth fintech sector through Mint, which operates GCash. In our opinion, growth will be driven by low financial inclusion in the Philippines, partly due to the difficulty of opening bank accounts. GCash capitalizes on this by providing easy-to-open payment platforms. We believe that GCash monetization will begin soon due to its fast growth and high user base of 26 million users. We expect to eventually see healthy margins for Mint, with global industry precedents showing average profit margins of 24.4%. We believe that Mint is a valuable investment that could make great returns thanks to strong industry trends and economics. In fact, Mint fits well with Glow's core competencies, which include their ability to implement reliable systems and track user accounts, which are key success factors in the industry. It is further supported by attractive economics, such as the network effect, switching costs, and economies of scale as the user base and industry grows.
We arrived at a target price of 2,335 per share, implying a 16.3% upside. Our target price is broken down into Globe's core business and its stake in Mint. We use a DCF model to value Globe's core business. For our inputs, we use a 7.41% WACC. Meanwhile, our terminal growth rate is based on the price inflation of utility services. Because telecoms are like utilities, we think this is a good proxy for long-term growth. For Mint, we use the latest reported valuation of around 50 billion pesos to value Globe's 40% share. To verify our DCF model, we conducted both a DDM valuation and relative valuation. Our DDM valuation indicates 16.4% upside, while our relative valuation shows that Globe is trading below its peers. Although this could be caused by Globe's higher expected capex, we note that growth prospects will allow Globe to recover its investments. In addition, we found that Globe is trading below the trend line when we graph EB to EBITDA relative to the degree of capex spending. Finally, we note that Globe is trading significantly below its historical PE ratio. We think that the market has overestimated the impact of competition, resulting in an attractive valuation.
Despite our favorable outlook for Globe, we recognize that Globe has inherent risks. Today, we will focus on three aspects of those risks. First, Globe has risk of having its assets taken by the government if they do not improve their services. Although the probability of this is unlikely, the impact of this on Globe's assets are very high. Given that the president has already caused another company to shut down in the past, we recognize that this risk is one that stands out from the rest. However, Globe has been mitigating this risk by increasing its capex in order to improve their services. Second, Globe faces competition risks due to the entry of DITO. However, we believe that Globe still has an advantage due to its economies of scale. In addition, our forecasts project increased capex which will allow Globe to compete. Finally, our sensitivity analysis shows that we maintain our buy recommendation as long as DITO's year 5 market share stays below 17%. Lastly, with Globe's continuously growing capex, this may lead to substantially lower profit margins. But we are confident that Globe will be able to mitigate this risk as it has done so in the past, and because Globe has tasked its board of directors to oversee major capex and their turnouts. On top of that, our sensitivity analysis shows that our buy recommendation holds as long as capex as a portion of revenues fall below 35.3%.
For ESG, Glow targets energy, carbon, paper, and e-waste management through various conservation projects. It also invests heavily in training and development for its employees, quality ICT education, and awareness programs for the public. Glow has an annually elected board with 11 members who are compliant with the best international CG practices. They have 6 board committees that oversee integral functions, a board diversity policy which encourages females, a mix of ages, backgrounds, and experience, as well as a long-term stock incentive plan to avoid agency risks, among other policies. Glow's 5-year ESG average score is 57 compared to PLDT's 43, although there's still room for Glow to improve and reach a global ESG standard.
In conclusion, we would like to recap the basis of our recommendation. We believe that competition is overestimated, causing stock undervaluation. We also believe that Glow has a superior home broadband strategy, safe dividend payout, and valuable investment in Mint. So with a target price of 2,335 pesos, representing 16.3% upside, this is Globe Telecom. Thank you, and we are now open for questions.